Markets closed the third quarter with U.S. equities ending their historic run without a 5% correction, as the S&P lost just over 5% intra-month. Global bonds similarly delivered negative returns as the normalization of 10-year yields in both the U.S. and Germany continued as expected. We believe that we're about midway through this rise in yields, and investors should expect a move to 2% in U.S. Treasuries and above 0% in German bonds for the first time since 2019. Fortunately for bond investors, credit spreads remain near historic tights, suggesting the worries of equity markets have not yet affected the optimism of usually more economically sensitive credit investors. As a result, risk management remains our focus in fixed income portfolios, especially with regards to interest rate risk looking through year-end. Instead, having reduced our risk appetite in the second quarter by exiting China and Asian credit exposure, remained focused on shorter duration opportunities in the leveraged loans and European bank CoCo markets for income in this currently yield-starved environment. In the equity space, with as much as another 50 basis points increase in U.S. 10-year yields from their end September levels, we have added to our existing positions in U.S. financials, which should continue to benefit from the next leg of increases in yields through year-end. As markets enter earnings season, investors should remember that as much as 75% of the gains realized in 2021 have come during earnings seasons, as companies have consistently delivered ahead of expectations. Indeed, while earnings revisions have moderated in September, as they typically have outside of actual reporting seasons, upgrades continue to outpace downgrades, laying the groundwork for a constructive earnings season in the weeks ahead. Admittedly, company reports will be noisy, as discussions of the impact of rising commodity prices, wage pressures, and supply disruptions will be common. As a result, we expect commodity and energy-intensive businesses to be at the greatest risk of disappointment, alongside those reliant on a steady flow of low-wage workers, which are currently in short supply. Instead, we expect to benefit from the rotation we made over the summer towards stock-focused, high-quality, high-visibility earning streams in the coming reporting period. For more information about how we're navigating the current interest rate volatility, as well as the earnings uncertainty, please visit us on ubp.com.